Moving forward, ladies and gentlemen, to our next panel discussion, which is going to talk about unlocking the value. It is my proud privilege to welcome our esteemed panelists on stage. We have with us Mr. Pankaj Jaju, founder and CEO, Meta Capital Advisors LLP, Mr. Sanjay Thakkar, chairman and founder of Group Landmark, PolicyBoss.com, a landmark insurance company. And moderating this session is Mr. Siddharth Bhandari, Director, Bhandari Automobiles Private Limited. I request gentlemen to please join us on the dais. A very warm welcome to you. Ladies and gentlemen sitting in the audience, can we hear a big round of applause and welcome them on stage? Thank you so much. Mr. Bhandari, I'd leave the stage to you. Thank you.
Hello. Yeah. Good evening, everyone, and welcome to the second session for the day. I take this opportunity to welcome both the panelists we have here. The topic for moderation today is unlocking the value of our dealership business. And there couldn't be a more apt topic considering the kind of turmoil we've all gone through, we've all seen, and we've all had the challenges. We've always pondered over the age-old question, do we raise debt or do we raise equity? And what better panelist to have with me is Mr. Sanjay Bhai to kind of take us through this beautiful journey. Sanjay Bhai, years back when nobody considered, the way the norm was ki bank mein jao, paisa lo, and that's how the dealership business ran. You went ahead and got TPG to invest in the dealership business. I'm not going to ask you why you did it and all that. I just want to know, what is the value that TPG saw in the business, and what made them, what was their motivation in investing at the Landmark?
Thanks for, am I audible? Yeah, thanks. Yeah, thanks for having me on the panel, Siddharth. Let me start by saying that India is today the fourth largest market in the world for automotive, and we will soon become the third. How many listed entities do we have? None. Let me give you an example of small countries like Sweden, Turkey, Australia, significantly smaller, and I can go on and on. Forget USA, China. And we have listed entities, dealership businesses over there. For reasons that one can get into, we have come from a very historic kind of a way of doing business, and which is that the ownership and the management has to be the same. This is something which has been ingrained in our minds of a lot of my friends sitting in the table and outside, that this has to be the same. The dealership agreements, and I'm really here to compliment FADA for the efforts taken by people sitting here about changing the dealership agreements. The dealership agreements for many of the OEs do not allow getting structured equity into the business. It is an onerous task. I went through this process and came out quite smoothly, but most of the other OEs do not even allow that. Now, if India has to grow, if India has to become a world power, which we also need, we need structured capital. Really, there should not be any surprise as to why this is happening. The question should be, why hasn't it happened so far? Why are we living with a situation which has been created and which is not to our liking? This is the question we should be asking ourselves.
Yeah, that's a very pertinent question. But, I want to take a step back from here. I want to, you raised a very valid point, ownership and the management, right? And I want to ask you, how did you, what were the steps you took in your journey to make yourself ready for that jump, What sets you apart from the crowd? How did you do that?
So what helped was that unlike a lot of friends in this crowd, I was never a very good operator. I couldn't operate dealerships so well. So we had professionals looking at the dealerships straight away. I used to live in Mumbai. Our dealerships were in Gujarat. So I was a kind of an absentee landlord initially. And we had professionals who joined us. So, and at that time we realized that we wanted a young team, a team that would be with us forever, and I'm happy that the senior management team of Landmark has been with us since the time we started, and we have kind of built the companies together. And we also did not invest in properties. Now, this is a very big statement I'm making, because most of the guys I know believe that the creation of wealth is by way of building properties, which to my mind can never be capitalized, can never be sold unless you exit the business. And in India, where the interest rates are, say, at that time were say 10% and the rental yields were at 3%, it made really no sense to buy property and sink in capital. So we focused on asset-light models. Each outlet had to make money, fast execution. That was something that we focused on, and that is what, when say TPG came looking at us, this is something that they liked. There were many other attributes that we were compliant and really our books were clean, but apart from that, it was the asset-light model that we had and the professional management team. I think the two topmost things that come to my mind.
You know, another very pertinent, topic especially for the finance symposium you spoke about a clean book. You know, the mindset that you brought in was having a very clean and transparent book. What made you change? What is the mindset behind it? You know, in a time, pardon my crash absolute approach, but dealers are known for, and we just heard some of the financiers, having that mindset that the more transparency, the better. What made you, before your time, see this as an opportunity?
I'm a first generation guy. So when in 1998 and 99 we started the business, what came to mind, and I was talking to Mukesh Bhai in the lobby, and the same conversation he said, one of the senior guys who we have and rightly respected, this business has a lot of money floating around. Very little of it is yours. Now, if you lose sight of that, then you lose sight of a lot of things. So we did not take out money. The personal books and the books of accounts for the company were completely kept separate. If my family was to travel to say in Ahmedabad even for a Diwali Puja, I paid for it myself. The company did not pay. Now that's the level of kind of discipline that we kept. We never did any personal expenses in the company. We plowed back the profits into the business, and whatever little capital we put has grown multifold today because of these kind of things that we did.
It brings me to an important conjecture in our junction, in our discussion. You know, from an investment banker point of view, and here is where I want your thoughts on this, Pankaj, is that a lot of money flows in and flows out. Most of it we don't realize is our own, is borrowed. When you look at it purely from an investment banker point of view, how do you see us auto retailers or auto dealers different from any other retail chain around?
Yeah, thanks, Siddharth. Answering your question and the point that Sanjay Bhai made, that there are more listed companies in smaller countries from the auto dealership industry and none in India. I think the key thing that an investor wants to do is to make money. And how does an investor make money? By investing in a company which is growing, where revenues grow and there is predictability of revenue growth, where margins are decent, and more important, the return on capital employed is very high. And return on capital employed is defined as how much money you make on the capital that you put in the business. In case of retail, most retailers who've grown never owned stores. So capital employed in stores was limited. They had select amount of inventory and they had payables, working capital was also small. And while margins were similar, single digit margins, but retailers were able to do a decent ROCE. In case of auto dealerships, what we've seen, and that Sanjay Bhai alluded to, that most people bought property, so ROCs went for a toss. Most people looked at growing top line, but not looked at what is the margin and what is the eventual ROC, how fast is your inventory turning, and hence ROCs remained low. The other point was that there are two types of businesses. One is a lifestyle business and one is a growth business. When I say a lifestyle business, it's something that gives you reputation, it gives you some amount of cash flow to maintain your lifestyle, and you are seen as an important player in the city. You are the Honda dealer in the city, or you are the Mercedes dealer, and people come to and talk to you. Now, those businesses where it's run like a family business, where books are mixed up, investors don't want to put in money. Unfortunately, most auto dealerships in India remained in that form, and hence from an investment banker perspective, while it's a no-brainer to say that, look, on paper auto dealerships should be very attractive. India is a growing auto market. Consumers are buying cars. You have great revenue streams from service, from insurance, from financing, used cars, and hence it should be a very attractive business. But because most people didn't organize, did not manage to grow and create the necessary requirements for investors to get excited. In fact, I've been part of Landmark journey for the last 8 years, and TPG looked around looking for dealerships where they could invest, and they could hardly find anyone other than Landmark. So very few dealerships have actually gone that path.
So, how do, summarize this and tell us, in a simple investment for dummies, if I can say, put it across right there. How does a dealership raise smart money? What does it need to do? Like point one, point two, ye karo, and an investor, smart investor will start at least looking at you.
Sure. So 4 or 5 things, and I'll put them down like you said,
Yeah,
simple
absolute
steps.
simple steps.
One is get in good quality management, which means professionals or from the family, but don't prioritize family over professionals just because they are family. People want to see management teams that can grow the business. So that's number one. Number two, ensure that your business mix is good, which means if you have 1 or 2 dealerships in a certain city, you are vulnerable because, the OE, if the OE's fortune changes, they don't have new car launches or whatever, you will get impacted. Your fortunes are not dictated by you. But if you have multiple geographies, multiple OEs, then at least you are de-risked, which is what is the second point. Third is have business systems and processes which allow you to grow, which means, reporting structures, what are the numbers, are they completely clean and clear? Because any investor who will come will look at the financials and say whether these are clean and clear. I think some of these, and the last is financial discipline. Do you invest in a dealership for vanity or for sanity? Just because it's at a certain location, you can buy the property, you do it, then that's vanity. But if there is a clear payback, कि आपने पैसा लगाया 5 करोड़ रुपया डाला एक particular location में, and you can make 2 crores out of it, then that's sanity. So investors will look at all of these before they put in money.
Sanjay bhai, we're talking to the investment banker, and he seems like he's got all the money, but does he bring anything else on the table besides paisa?
Yes. Yes. Things that we would never have thought of. Now, since we are going to be hitting the public markets in some time, I realize that we need to have nomination and remuneration committee. The salaries that we would be paying to our senior people has to pass the muster. We had a case of a OE large listed company whose managing director's salary wasn't cleared in the shareholders meeting. Now, we never think of it that way. We have an audit committee. We have a CSR committee. So a lot of structuring goes into it. Uh, as far as Landmark is concerned, we also get one of the big four as the auditor. So the accounting norms, and since I know a lot of dealers, their accounting norms which are audited by local chartered accountants, not taking away nothing from them, are different from what, say, a big four really wants. Recognition of revenue. How would you say that recognition of expenses, contingent liabilities? Now, all these things, something that we learned. The corporate governance is what came to mind. We also went through, since it was an American fund, Foreign Corrupt Practices Act, that there is no corruption in the organization. So, a lot of things, and I think it is a mindset that we have ourselves that, oh, it's just a dealership. What can really happen? You will be surprised to know that the auto dealerships today are trading at a higher multiple across the world than any other OEs. All the OEs that we are representing in the table over here, except for the Indian ones abroad, are trading at a single digit P. The dealerships are at a multiple which is higher. Now, this is something that people need to believe in themselves that yes, it can happen. The moment you think that it can happen, it will happen.
You know, you brought in some very pertinent points, but I have one. मैन-पावर कहाँ, अमेरिकन सर कि इंडियन? मैन-पावर कहाँ से आता है ऐसा? क्योंकि हम तो ऑटोमोबाइल डीलरशिप बिजनेस में when we first sit around, how do you attract good manpower? How do you get people to kind of come into your automobile dealership and think in a structured manner the way you've spoken?
We have the biggest banks in Asia sitting here. Where did they get their manpower? The Marutis of the world, where are they getting the manpower? Now the point is that if you show them the path, if you give them wealth creation, if you give them autonomy, the way my opening statement was that if you separate management and ownership, things will happen. Now you don't need to be hovering around them and trying to outguess them. Move out of the way. So good talent is there. The ability to pay comes from your ability to generate more from the store and taking out completely the personal expenses out of this. So it is a very high ROC business. If done well, it is a consistent business and investors across the world like it. It's just that we believe that it in India, this is the way it has to happen. Now, that's what it is.
Very well put. I think, you know, when the Indians around the world are heading at the top, why can't we as auto dealers kind of attract the best talent as well? Very well put. There's a myth that I'd like you to answer for me. You know, when we talk about value in an auto dealership, and the minute we say value, everyone looks at after sales. So I want your take on it. Kya hai? Where is the value, Sanjay bhai?
So we have looked at business models across the world, the dealership models, and the Indian business model is unique. And because it has been happening for some 30 years, we believe that this is what the world is. Not so. So the American dealers make more money out of pre-owned cars. 30% of the pre-owned cars sold in America are done by the new car dealers. Now, when we actually complain about some of the startups, I need not name them, everybody knows who I'm talking about and how they get these valuations. Where are we in the ecosystem today? Where is the technology? Where is the transparency that we can bring? The Chinese dealerships make a huge amount of money out of accessory and spare part sales. Here, we believe that the only source, and again the dealership agreements are, and I'm sure FADA will amend it in the times to come. We believe that the parts margin is what the OE gives us. AutoNation in America buys parts from Taiwan under white labeling them and selling them. Now, there are examples and there are examples, but to believe that the money comes from after sales is not true. The point is that money also comes from sales. And it should come from sales, from insurance, from finance. So when I say sales, it is a combination of the deal that we all give to the dealer, which is a kind of a combo deal.
Yeah. Sanjay bhai in his value also mentioned the online portals. Pankaj bhai, we've seen tons of them raise money and ultimately they all come to the dealer and ask us to kind of execute their business. Now these guys with their billions of dollars raised ultimately come to one of us in the room asking us to execute their business. You've already given us the 5-point mantra, but yeah, even if we can't raise money, how can we outdo them in our small little shop that we are running? What is that one thing we can do to kind of be ready at least to compete against these guys?
So it's not just auto dealerships, but across industries, disruption is happening because tech is enabling new business models. And some of those will become large winners and investors are chasing those in the hope that one of them will become the next Amazon kind of a story. Reality is that, the online players will need an offline presence and offline players have to go online. The online guys have a wide canvas, it's an open place, and they have the ambition and hunger to run fast, and they are capturing real estate there, and which is why they are getting those valuations. Personally, I believe it's going to be a convergence. So some of the dealerships here who are offline, who can bring in talent and thinking to disrupt themselves before others disrupt, will be able to do things right. It will require a big mind shift change, number one. Number two, it will require a lot of investment and attracting the right talent. And for dealers who are sitting here today, I think what it is requiring is to think about what way the industry may change. How will the consumer change and how can I be ready to meet that consumer there? So if the person wants to browse online, can I make that easy? If the person wants to book a service online, can I make that easy? Can I do it for myself? Can I do it for a few other dealerships around me and create critical size? I think those are simple ways that one can think about at least bettering our own service and meeting the online players in their game.
So, in today's scenario, is it possible to buy out an existing dealer? I mean, how would you value the business to go about?
So long and short is that every business is valuable for its cash flows. And the second reason a business is valuable is what is my build versus buy if I'm looking at buying out a dealer. Now, if it's a single location, one dealership, then the value to that extent is limited because it's easier to build than buy something and integrate because that place will be run with certain systems, certain processes, certain culture. Integrating all of that takes time. On the other hand, if it is a dealership which has multiple OEs, multiple geographies, good team and profitable, good cash flows, then for someone to buy, whether it's a financial investor or a strategic, it will make sense. Valuations are right up in the air. At this point of time, most dealerships that, and given that last few years have been a struggle for auto dealers in India, valuations have been more in terms of what can I get and get out versus getting a real value. But typically, a few location dealership will probably get traded at a fraction of what a large multi-brand, multi-location dealership would trade at. And if a large multi-brand, multi-location dealership will trade at, let's say, 15-20 multiple, then probably a single location on a small dealership will be at 4-5 multiple. I'm just giving a ballpark.
Yeah, I mean, so my final question, and here's where we break the myth that I started off with, and I'm going to go to Sanjay bhai first and then I'm going to come to you, Pankaj, is bringing in equity instead of debt our answer to better profitability, or do we ride with caution?
Let me ask Pankaj to answer this first.
So there's a very simple philosophy in my mind, and especially for businesses which have low margins and high fixed costs. If you have high fixed costs, your operating leverage is already high. A small dip in sales and the business can move from profitability to loss. Now, if you are already having high operating leverage and if you add financial leverage on top of it, then it's a recipe for disaster, because one downturn and it becomes difficult to manage that. The second thing I want to say is that people think equity is cheap and debt is expensive. Reality is debt could cost you 8, 10, 12, 15% depending on what your financials are, but equity is 30% plus. No person putting money into equity wants to less than double his money in the stock market in 3 years, which means your expectation of return on equity in a publicly listed liquid stock is 25%. If somebody is putting money into unlisted private business, the return expectation is even higher.
Sanjay bhai, any?
Yeah, so I will answer it in a different form, where I'll say that it is a mindset issue. Now, do you want somebody questioning you? Do you want somebody on the table? Do you want somebody saying that why are you having so much stock, when your regional manager is saying that if you buy 100 you will get 1 trophy? Now, these are the questions which are softer questions. These are the questions that one needs to ask oneself and then come to that answer. Pankaj has answered the financial aspect of it. I am talking about the day-to-day softer aspects that we all live with day in, day out.
Thank you for bringing the dealership perspective to it. With that, I open the questions to the audience. If you have any questions, you can raise your hands.
We have a very attentive yet silent audience. No questions? All right, then that would be it. Thank you so much, gentlemen, for that very wonderful discussion. I'd like you to stay in for a bit because I'm going to invite Mr. Jameer Ajmera to please join us on stage and felicitate Mr. Pankaj Jaju. Is coming from right behind. So I'm going to also welcome our next Mr. Kaushik Kothari to also join us on stage. Yes. So Jameer Ajmera will be felicitating Mr. Pankaj Jaju. Request you to just step forward from the table, please. Thank you. I'd like to welcome Mr. Kaushik Kothari, who will be felicitating Mr. Thakkar. And thank you, Mr. Bhandari, for moderating the session so well. I'd like all three of you to please join us forward for a picture together. Ladies and gentlemen, give them a big hand. They have discussed unlocking the value. Thank you so much, gentlemen.